Hello, everyone. It's George Coyle again, the founder of Triangulated Research, Triangulated Capital Management. And today I'm going to start a series where I talk about trading. Can't get away without talking about trading, something near and dear to me. So today I'm going to go through basically the main trading principles, and I put together a little presentation. So I'm going to do the thing where I'm the little character in the bottom of the screen on the left while I show you the presentation. So let's get it started. Okay, there I am. So there's the company name Triangulated, and trader principles is what we're going to talk about today. So bear with me for 1 second. Okay. So first, what happened several years ago, I wasn't getting the results I wanted from my own trading. And so what I decided to do was to go out and do an independent study. And I looked at dozens of traders over 125 years and counting. This goes back to the late 1800s. And I ultimately ended up creating a matrix where I put the traders on the y-axis and then various factors related to trading or investing on the x-axis. And I went through and I checked little boxes. So I would say, okay, Ray Dalio says that diversification's the holy grail. Check, right? And then I would see that someone else said something else. And really, when I did that exercise, it was very enlightening because what I found was there were only three core commonalities that were common to all of the different people. And that's what we're talking about today. I call them the trading principles. So here are the three. The first is that you need to respect price action and follow price trends. The second is that you need to cut losing positions, cut losses. And the third is that you need to hold on to your winning positions. And we'll get into these a little bit more. But up till now, I've basically put this research out via a free PDF, but a lot of people have said to me that I should turn this into a book. So I decided, hey, I'm going to listen to them. And pretty soon there'll be a Kindle edition for purchase on Amazon. So I'll let you know when that comes out. But in the meantime, let's keep on moving. Okay, so the first thing is price trends. And this one goes by a couple names. Some people call it trend following, some people call it following price action, others say it's listening to the market. The bottom line here is that great traders analyze, respect, and utilize price action in their actual day-to-day trading. And we'll get into like specifics over time in this series, but I'm just going to go over the highlights today just for people that maybe aren't that familiar. So what I want to do is show you a couple quotes, some of my favorite quotes from some of the great traders of all time that hammer home, sorry about that, the points. So let's start with Bernard Baruch. And what he says here is that with rare exceptions, stocks are high because they are good and stocks are low because they are of doubtful value. So it's a pretty easy concept. It's, you get what you pay for. A stock that's high priced is probably a better stock than one that's very low priced. The next one is Humphrey Neal. I couldn't find a picture of Humphrey, but I found a picture of the cover of his book. What he tells us is that we cannot know what the insiders intend to do, but we can see their orders on the tape when they execute them. That is why my plea is for every one of us to have no mere opinions of his own, but to allow the action of the market to tell him what is passing. So I think this is very, very interesting, right? Basically what he's saying is don't listen to what the guy tells you he's going to do. See what happens on the actual tape, because he can't lie about his orders, he or she. If they're going to buy the stock and it's going to impact the price is going to move up. That's where the truth is. And the third one, and probably my personal favorite, is Bruce Kovner, who says that the market usually leads because there are people who know more than you do. And this makes sense. There's people out there with a lot of money. They probably don't want to lose that money. So if a market is moving, there's a decent likelihood that someone with a lot of money is making that market move, and you should pay attention accordingly. All right, so now we get to number 2, cutting losses. So be quick to get out of losing positions so you don't allow a small loss to become a big loss. Well, let's hear from some people here. So here we have Jesse Livermore. He's kind of the grand poobah of traders. He had a unique hat and glasses for his era, but he says the speculator has to insure himself against considerable losses by taking the first small loss. Next, we have Nicholas Darvas. He's another, famous guy. If you study the history of great traders, he wrote a book called I think it was How I Made $2 Million Trading in the Stock Market, or that may not be the exact title, but close enough. Anyway, he said, losses must always be cut. They must always be cut quickly, long before they can become of any financial consequence. So don't allow a small loss to become a big loss. And third, we have Larry Height, who's probably my personal favorite here too. He's a character. He says, you see, the first thing for any organism, for any animal, is survival. Cutting losses on anything gives the chance to endure. That's Spock-like logic, simple math, simple physics. So that quote comes from his book, The Rule, which I think is just a great book. He's just such a colorful guy, and he's got a great way about him. Anyway, all right, so that brings us to number 3, which is that you need to ride winners. And the idea there is you have to stick with your winners so that they pay for your losses. So let's hear from 3 people on this one. First, we have Gerald Loeb. You may not know who he is, but if you study the history of stock traders, kind of like academic papers refer to one another, Loeb is a guy that gets mentioned often. He was really active kind of in the 1920s to 1960s, but he tells us that trading must be aimed at obtaining a sufficient profit to offset the average losses sustained in all investments. So you have to have big enough winners to pay for your losses. Next, we have the first market wizard, which is Michael Marcus. He's one of my personal favorites. I wrote a paper on him. You might like to read it. But anyway, he says that if you don't stay with your winners, you are not going to be able to pay for your losers. So if you have a loss of $1, you need a gain of more than $1 to pay for that loss. And losses are inevitable in the business. And finally, the great Martin Zweig, he says, according to my rule book, the only consistent way to make money in the markets is to cut losses and run with profits. So like dozens of others, these guys, and Martin here in particular, is telling us that you have to stick with your winners to pay for your losses. Okay, so let's summarize very quickly. You respect price action, follow price trends, cut losses quickly, and then ride winners. Those are really the only 3 things that I found that were consistent across dozens of traders over 125 years. So the question then is, well, how do you do this? And I'm going to say stay tuned. You know, this is a little before my time, but there was a Batman show in the 60s, and they would end on a cliffhanger and stay tuned for tomorrow. Same bat channel, same bat time. So I will say the same and tell you I'll be back with more in future videos. Thanks for watching.